Did you know that during the Great Depression, people were burning down their residential and commercial real estate just so that they wouldn't have to pay property taxes? Such is the importance of having a conservative capital structure, not only from a business standpoint, but from a personal finance balance sheet perspective as well. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will, and I'm joined again by Brian and Elliott. So let's talk about conservative capital structures. Why is this so important?
Well, as you know, business conditions are not always going to be rosy. There's obviously business cycles. And so you want to make sure that you own a business that can survive a deep recession so that you avoid blow-up risk and losing it all.
And there are a ton of examples just in the last 10, 20 years. You think about the pandemic that we just experienced. You think about the great financial crisis, the 2000 tech and telecom bubble and recession. They come at you fast and they come unexpectedly.
So what are you looking at when it comes to balance sheets and the strength of balance sheets?
Well, typically you might think of some standard ratios like interest coverage ratio, where you look at how much interest are you being charged, and how many times could you cover that interest? So maybe your cash flow is 5 times the interest, or maybe it's 50 times the interest expense. With the thought that even though debt's coming due, there might be this belief that as long as I can cover my interest, eventually the capital markets, if they're open, I can refinance and roll over my debt. But with interest rates so low, we're looking more at what the net debt is. So meaning all total debt of the company, long-term debt, the current portion of short-term debt. And we look at all this debt, subtract out the cash that's on the balance sheet, and then we're dividing by what the actual operating income is of the company to understand how leveraged they are. So basically net debt to EBITDA or net debt to EBIT, earnings before interest and taxes. But one other thing I'd throw out there is it's not just what's on the balance sheet, but it might also be what's off balance sheet. So for example, you could have a lot of leases where you're leveraged, locked into a lot of leases, which historically they used to not even be on the balance sheet. And now they're requiring that those get capitalized. And then there's pensions. So with pensions, we've seen scenarios where there's automobile companies and airlines where literally the size of the pension was larger than the market cap of the company. Think about that. The market cap represents all the cash flow that is estimated to come, the value of all the cash that's estimated to come to shareholders over the life of the business. And the pension exceeded the size of the market cap. Well, that's a hungry beast there that's going to need to be fed, especially if your pension assumptions are off.
Yeah, and I would also just mention that we like to see management teams and we also try to think about not just sort of what has happened in the past, because sometimes management teams will say, okay, I'm going to look at, and I think the airlines to some degree did this in the most recent crisis, where they said global air volume tends to go up. Even in recessions, it doesn't go down, that much typically. But then, the future is surprising and very unexpected things can happen. And so you look at what happened in the pandemic. Airline volumes, obviously, as everyone knows, totally collapsed, far outside of any historical precedent. And so we like management teams that don't just think about what's happened historically with their business, but what could happen, and that they take a conservative approach to that and just try to be even more conservative than you would think based on history.
So it's clear to us then having a conservative capital structure is very advantageous for survival. But are there any other advantages that you can think of, Brian?
Well, yeah, sure. It's not only can they survive in a deep recession, but can they thrive? If you have a conservative balance sheet and you go into a recession, you can use that conservatism to now potentially take advantage of the environment and maybe acquire other companies that are struggling and need your help. Reminds me of the quote from Buffett that you see who's been swimming naked when the tide goes out. And then the other thing I'd point out is if you are owning a business that requires leverage to get a good return, you're in a much more precarious position. And so we like to look at return on tangible assets, because businesses that have a high return on tangible assets, they're already generating a high return. But if you have a low return on assets, the only way to juice the return for the shareholders, for the equity holders, is to leverage up. And so that helps explain why sometimes we've stayed away from certain companies where the businesses look attractive, but we want to be careful not to put ourselves in that precarious position where the returns are coming because of the leverage.
I love that. I think, thinking about the shareholders, thinking about the long-term longevity of the business, all of these points are so critical to consider, not only from a management team perspective, but it's something that we think about as portfolio managers. And all the stocks we've mentioned should not be considered a recommendation to buy or sell the stock. Obviously, consult your financial advisor for your specific situation. You can also request from YCG a list of all the securities that we've recommended over the last 12 months. Thanks for watching. Check out our other videos, and we'll see you next time.